The opposite is true. If it's an outgoing item, then we also find ourselves within that space. If it's an asset and expense and that's an outgoing, then we are saying that if it's an outgoing, it's supposed to be what? Credited. Supposed to be what? Credited. What's the meaning of that? It's an outgoing item supposed to be credited. Let's take an asset. Let's say we have used a particular asset for a quite number of period. Let's say it's a motor vehicle, right? You have been using it for a number of years, and we realize that at a certain point the business has gone inside that we can no more use that vehicle anymore to assist in our operation. What do we do? Since we can't leave it to, just to be within the organization and then with of no use, why don't we sell it? So that we know that we have sold it and then we have some small cash to help in the running of the business. So at that point, when we sell the asset, it means that that asset is moving from the asset group and is going out toward a third person. It's an outgoing. It's moving from the business to a third party or a second person or a third party. We call it what? An outgoing. So we are saying that all items that will comes as a movement from the business to another person, we call it an outgoing items, and in that way it's supposed to be what? Credited. If it's an asset or expense, it's supposed to be what? Credited. So all outgoing items with respect to assets and expenses supposed to be what? Credited. So let's take note of that. For example, when it comes to the expenses too, if you are writing off any expense item from our books, for example, let's take bad debt. When we say bad debt, they are debt which comes as a result of customers not being able to pay the amount that they own the business. It can be as a result of, the customer is out of business. It can be as a result of bankruptcy. It can be as a result of the customer going mad. We can't hear from the customer anymore. All these issues can accounted for by bad debt. So when it happens that we can no more recover that amount from that customer, then we cannot keep it also in our books, because bad debt is supposed to be kept in the books for approximately 5 years or something of that. But once that period elapsed, we cannot more keep it. We need to write that debt from our books. And because it's an expense, when you are writing any expense item from our books, the idea here is that it's going out from the business and supposed to be what? Credited. Because we know that the expense have a debit balance. So if you are writing it off, if you are removing it from our books, then we're supposed to what? Credit it. So all items under assets and expenses that is outgoing supposed to be what? Credited. So let's take note of that. And then the issue about capital, revenue, and then liability. If it's also an outgoing item, what do? We debit it. What do you mean by debiting it when it comes to outgoing item? Pretty simple. When we have the issue about capital, classical example, drawings. Let's say the owner of the business or the investors are taking off their shares, they are taking off, their investment or capital they invested in the business. They don't want to invest in the business anymore. They are not interested in the business anymore, and they are taking part of the amount or total amount from the business. That means they are withdrawing what? Their investment from the business. And if you are withdrawing it, at first when you provided to the business, it was a credit to your account. But once now you are withdrawing it from your account, it's supposed to be debited. So by debit means that when we have the capital account like this, okay, when you first provided the amount, it was at this side. So it's at the credit side of the owner account. That's your amount you have provided. But now you don't want to work with us anymore, and so you want to take your money, drawing. So that was supposed to be the same amount supposed to be at the debit side, so that to remove that amount you have redeemed from your account. This is what we mean by debiting it, by recording it on the left-hand side of what? The capital account, which is the T account that we're supposed to have here. So drawing is also an aspect. So if there is any amount that's being reduced by the owner or the investor of the business, then they are saying that you're going to debit it. It's also an outgoing item, because drawing is an outgoing item. It's going out from the business back to the owner. So it's outgoing. So what do? We debit it. Revenue, for instance, if you want to cancel out any revenue item, for instance, let's say we made a sales for about, let's say, $100,000, and we realized that at a particular point, some of the customers bought the item saying that it didn't meet their preference. There was some defect or fault in the product, and so therefore they are not interested in it. And since there is a policy that the customer can return an item, let's say within 15 days or so, then once they return the item, that means that that sales of $100,000 you have made will reduce by the level of drawings that they have made. That means at that point, we are going to pay the amount that they paid to us before. We are going to pay it back to them. So that means at that point, what part of the sales will then have to go back in the form of cash to the customer. It's also an outgoing. So when there is an outgoing item with respect to revenue, it's supposed to be debited. So when you have the revenue account like this, at first, when we make sales, to be at the credit side here, this is the right hand side of the account. When there are any returns by the customer, for example, it can result to what? I mean, a debit by reducing the part of the returns that the customer is bringing into the business and then record it at the credit side of the revenue account. This is also called an outgoing, or when we are deliberately reducing our revenue because of there was possibly mistakes or errors in the recording of the revenue amount to, what do? We'll debit it by recording it on the left hand side of the T account. So that is the idea when it comes to the revenue issue. So if that is the case, then we'll have to do a debit where there is any sort of mistake or returns of part of the revenue that we made to our customers, or whatever be the case, that will cause for us to reduce our revenue balance or reduce our revenue amount. You're supposed to debit it, and that will result to an outgoing of a revenue item, right? Whether revenue, income, sales, whatever it is, but we are using revenue to stand for it, supposed to be debited, right? Then lastly, when it comes to the liability liability in the form of let's say payment of our liability, payment of debt. When there are mistakes in how we recorded liability on the credit side of the account, right? Or when we are deliberately canceling part of our liability as maybe per the loss of the business or something of that sort, then it's also part of an outgoing item, and you're supposed to record it also at the debit side. So for liability case, when you have a liability account like this, at the beginning, when the liability is created, it's supposed to be at the credit side, as we talk about an incoming item, right? But where it is outgoing in the form of payment of it, or where we are reducing it, or even when there are mistakes in how we record it at the credit side and want to correct it, we do so by recording it at the debit side. We also call it an outgoing item when it comes to the liability account. So let's take note of that. So that is the idea when it comes to the incoming and then the outgoing. So that's also another principle when it comes to recording of business or transaction using a double entry. And in summary too, others might also say that when it comes to double entry, we say that we debit the receiver, we credit the giver. What is the idea here about debiting the receiver, crediting the giver? The idea here is that when it comes to double entry rules or the principle, we have for two parties at work, right? We are going to personalize them as more like human beings. So let's say we have part A account and we have party B account. Then we have party B account. All right. So if it is part A that is given, follow carefully. We are just using them as human. We are personalizing as human beings so that you understand the principle better. If part A is the one giving, if part A is the one giving the item of financial character, then we are saying that we credit the giver. So by crediting means we record it on the right hand side of the T account. So we're going to record it here. So we record it in the name of who is part A giving that transaction to. It is B. So we are going to record in the name of B. So we'll bring the B name here. This is what we call narration. So while we record any transaction with respect to the party who is being affected, in whether the party, the one giving or receiving with the other person, we call that name as narration. So here part A is the one. Let's give an example. Let's say the example is that, part A, like say part A made a sales. So sales to party B, right? A sales to what? A sales to party B. Even though the language might be a bit different, but just want to make an idea from what I'm saying. So let me put in a good way for you. A sales from party A to B. Amount $1,000. So at this point, there is a sales. There is a sales. Even though we'll come back to the actual, item that's supposed to be affected, but I just want to explain the principle of giving and then receiving. Debit the receiver, credit the giver. So here, the sales was coming from part A to party what? B. So who is the one giving? Party what? A. So part A is the one giving, means that we are going to credit part A in the name of the person receiving it, which is what? Part B. We record it here and then record the amount here. And then, who is the one receiving part B? So part B is going to be debited in the name of what? Part A. By debiting means we record it on the left-hand side of the T account. So we record it here. And you are good to go. So that is the idea when it comes to debit the receiver, credit the giver. So for example, sales from part A to part what? B. So here the account that will be affected will be what? Sales. To bracket, let's say from part A. Then to B. So that means B might be a customer or a customer that is buying from what? Part A. And part A might be a business. Right? So we'll have what? Sales into bracket part A, and then we will have what? The customer, which is what? The B. So part A, since part A is the one making the sales, it is going out. We said that all outgoing items with respect to, revenue supposed to be credited. That's why we are crediting this here, outgoing. So we credit what? The giver, and we debit what? The receiver. So that is the idea when it comes with the debiting the receiver and credit what? The giver. So let's take note of that. So as a quick recap, we are saying that when I have T account like this, so this is an account, let's say A account. Here in this account, there are certain items that are supposed to be present. Here we record the date of the transaction here. You have the dates here, written here. You have the narration also here, the narration, the one who's going to be affected, and you have what? The amount in terms of the currency going to place it here. So if the date is first 25, that's fine. In the name of, let's say B, you record it. The amount, let's say it was in Ghana today, so 500, you record. The same also happens here. If you are having any credit balance, the same idea. You have date, we will have narration, and we'll have the amount also coming up here. So if it's a different thing, if it is second 2025, the narration is, let's say, Mr. C, and the amount you pay was 700. So you have your currency down here. You're not going to write these names there, but I'm trying to explain that these are the things that will be featured on top of the date. So this date will be here. So if it is 2025, you're going to write the year 2025. Write it here. Then you're not going to write this narration, but you're going to write the name of the one going to affect it in terms of receiving or what? Giving. And then write the amount, currency, write it there. And then write the amount below it. So this what comes when it comes to what? The T account. So we have the left page, okay, the left hand side page, and then we have for the right hand side what? Page. So let's take note of that. So that is the idea when it comes to the T account, for which a double entry is being what? Affected. And then another aspect has to do with the various classifications of account that we may have. I think we have even discussed them indirectly, but we didn't mention them specifically. When it comes to the classifications of account, we have two forms of account. We have personal account and then impersonal account. Let me use this space. For the classification of accounts, we have two. We have one, personal account, okay, and then we have what? The impersonal account. The personal account and then the impersonal account. So when we say personal accounts are accounts that records items of persons and business. Take note. Personal account records items of persons and what? Business. So persons persons and business. Persons and businesses. So, for example, persons like we may have what debtors, creditors, debtors, creditors. We may have what owners or investors. They are all part of persons, and the business itself. For example, issues about cash book, things that goes into the cash payment and receipt of cash and what check can be part of persons and then business, right? That falls under the personal account. So all items. So that means that here personal account here we are referring to the private what ledger, we are referring to the sales ledger, we are referring to the purchase ledger, right? You are even referring that to what the cash book as part of the books that we use to record what cash and receipt for the business. So persons and then what business. But when it comes to the impersonal account, the impersonal account will take care of what items of real and nominal. Items of real and what nominal accounts, and that will also be featured in the general ledger. So all items in the general ledger will be treated as what impersonal what account. Will be treated as what impersonal account. So these are the various classification of account that we have. We have the personal account, which are person record items of persons and business, and then impersonal account, we record items of real and the nominal account. I think we have dealt much more issues about these items that we have presented, so I'm not going to go back to it again. So that is the idea when it comes to the personal, personal and impersonal account, another classifications of what the account, and then the page for the T account where we have the date narration, then there's a narration on both left and right that we're supposed to understand. So that's the idea here when it comes to the double entry. So once you are able to get this right, let's try to put some examples so that we know how to go with it. So example, bought motor vehicle worth what 50,000 Ghana cedis. This is an example I will be giving you as you apply double entry to record this. So the first thing we need to ask ourselves is that what are the accounts or what are the items that are affected here? Bought motor vehicle worth $50,000. So before we can get a motor vehicle, that means that there should be some form of l'argent, money, that must what be paid. And in accounts, we refer to that money as what? Cash, we may refer to as cash or what? Or a check. But where it is not categorically stated that we bought with check or we bought with cash, then we go forward. The idea is that we go for cash. So that means that before we get in this motor vehicle, we pay a cash of what 50,000 dollars. So that means that the account that will be affected is going to be the motor vehicle that we bought, and then the 50,000 which is what the cash. This is what I was trying to explain here with respect to debit the receiver, credit the giver, where we personalize them as being form of human being. So what is happening here is that when we bought the motor vehicle with 50,000 worth, something went out and something came in, right? So what came in was the motor vehicle that came in, and what went out was for the cash of 50,000 that went out. If you remember, we said that when it comes to the double entry rules with respect to incoming and outgoing items, we said that if there is any item coming in under the asset, what do? We debit it. And any item that's going out under the asset, what do? We credit it. Because 50,000 cash and motor vehicle, they are all what? Assets. But the motor vehicle is what? A non-current asset, and then 50,000 worth cash is also what? A current asset. So if it is an item of asset that is going out, we credit the item under that what? Asset. But if it's coming in under asset, we do what? We debit it. So you are going to open two accounts. You're going to have motor vehicle account, okay? And then you have for your cash account. You have your cash account coming up here. So as always, all the currency was in what? In dollars, so you record in dollars. You record in dollars as well. Think, am I true? Yeah. So here, you record in dollars. There was a date, January 1. So that means you're going to have what? Here, January 1. January 1, we bought what? Motor vehicle with cash of what? 50,000. So here, this is where the narration comes to town. Why are we recording the 50,000 in the motor vehicle account? We are recording it because we bought the motor vehicle with what? An amount of what? $50,000 worth cash. So we're supposed to record so that when somebody picks the account of the motor vehicle, you see that, okay, on this said date, the business bought the motor vehicle with a cash of what? 50,000. So the cash will be here in the name of what? The cash. Because if we bought the motor vehicle with check, then we'll have recorded the what? Bank here. That means we pay through bank. But since we bought with the physical cash or cash in hand, we are going to record the narration in the name of cash here. So you just have to interchange the narration. If you are recording anything in the cash with respect to the motor vehicle, you take the motor vehicle name to be the narration in the cash account. If you are recording anything in the motor vehicle account, you take the cash name to be a narration in here. So we're going to have here as what? Cash. All right? And then record what? 50,000. Record 50,000 here. Since we are receiving it, we said that if it's an item of incoming in as a debit, it's an asset item supposed to be debited. That's why you have recorded on the left hand side. And by debit means you record it on the left hand side of the T account. But if it's an outgoing item of what? An asset, what do? We credit it. So here we have also our date coming up, January 1, then in the form of what? Motor vehicle. Shorten it, right, because of my page, and then I'll record it as what? 50,000. So record it 50,000. And we are good to go. So that is the idea when it comes to how double entry goes when it comes to the recording. Example 2, January 2. Additional capital introduced into the business amounted to 20,000 US dollars. So how then do you also record this? We said that additional capital, so the underlying idea here is additional capital. This is a capital that investor has pumped into the business as an additional capital or additional investment. So how do we record this in the books of the account? So the item going to be affected here is what? Capital. And what did they introduce actually? It was what? Cash. So here, the amount that you see here is cash. So the item that will be affected, or the account that will be affected, is going to be what? We're going to have capital account, okay? And then we will have what? Cash account. Cash account. So we have capital account and then cash account as an additional capital. If you remember, when we were discussing the principles of the double entry, we said that all incoming item under the capital should be what? Credited. Because it's coming into a business, an incoming item, it should be credited. It's coming from the, investors. So that means they are the one giving it out. So the principle is there that credit the giver, debit the receiver. So we are receiving it in the form of cash. So it's coming to a business. So we'll debit our cash account and we credit what? The giver. This is what? The capital from the investors. So we said also that when it comes to writing of amounts in the account, there should be a narration. And narration is going to be the interchange of what? The headings of the account. So if I'm recording in the credit side of the capital, I'm going to record it in the name of what? Cash. I'm going to record it in the name of cash. So I'll have it here. And I'll have my date here, January 1. So just January 2, rather. So 012, right? So we have here 0201 as January 2. Then we'll record in the name of what? Cash. Remember your currencies. Supposed to bring your currencies as well. So January 2 cash. What was the amount? 20,000. So we record it 20,000 at the credit side. And for the cash account at the debit side, or for the cash account, we are going to record it at the debit side because cash is receiving as more like human beings. So debit the giver, since capital is coming from the investors, will credit what? The giver, and then we'll debit what? The corresponding account being receiving. So we'll have is also here 0201 in the name of what? Capital. So we'll have capital. Let me shorten it, capital. Then we'll have what? 20,000 coming up also here. This is the idea about the double entry with respect to this example, relation to capital and then what? Cash. So let's take note of that. Let's take example 3. Cash sales for the period amounted to what? 40,000 Ghana cedis. We have cash sales for the period amounted to 40,000 Ghana. So which accounts will be affected? So here it is sales that we made that we're able to generate what? Cash. So the sales comes in the form of we selling what? Our goods or our stocks to our customers, and then we generate what? Cash. Right? So that goods that we sold in general or in generic term, we call it what? Sales. We call it sales. So the account that's going to be affected is going to what? Cash and what? Sales. So you are going to open an account for cash, we're going to open an account for what? Sales. So we'll have our cash account coming up. Okay. And then we'll have what? Our sales account also coming up here. But I'll teach you something about these transactions going forward. So just stay tuned. So what is the currency in here? We have USD. So you present them the USD. Remember here, there wasn't any day, so there's no need for you to bring it in. So what is happening here is that we engage in what? Sales. So that means goods were going out and then cash were coming in. So what do? We said that the rule for double entry is that at any time an item is going out, what do we do? With respect to sales, what do we do? Or revenue. We have to do what? Credit it. And whatever we receive as cash or whatever as a check or cash coming in, we do what? Debit. So that is the idea here. Sales is going out or inventory is going out in the form of sales. So we're going to credit what? Sales, and then we'll debit what? Cash as incoming what? Item. So what do? We have to debit what? Cash account in the name of what? Sales. So we'll have sales here. And what is the figure? Is 40,000. So we record 40,000. You record it. All right. Then we come to the sales account. Since it is going out, we have to credit it in the name of what? Cash. In the name of cash. So we have cash here with an amount of what? 40,000 down the line. So that is the idea here when it comes to what? The cash and sales transaction. Let's take another example. Before we come back to example 4, I didn't mention the fact that I will tell you something about these, transactions. You see, in example 2, we're having cash accounts being created here. In example 3, you're also having what? Cash account being created here. When you are given a series of transactions as a full set of portion, and you have what? An item or transactions that tends to affect a particular account over time based on the question, you are going to create that account once. Just that what you're going to do is that you are going to what? Make it so big and elongated in terms of the horizontal, the vertical is going to what? Well elongated, so that you can take care of all transactions that will affect that particular what? Account. So you're not going to open that account more than what? Once. So for instance, like this, if you have example 3, which is affected by example 2 as part of example 2 transactions, all I'm going to do here is that we're not going to create the cash account again, but rather we are going to record it straight at the debit side of the cash, and we only create what? The sales account. So there is no point where you create what? More than one account when it comes to a series of transaction given. So what I need to do is to make sure that your account open is very, very long, so that you can take care of all other transactions that will affect that particular item of the account. So let's take note of that. So that's the idea on top that I wanted to let you know. So let's take note of that. So let's come back to example 4. Sold goods on credit to Yamensa worth what? $1,000. So there is a sales. So that means inventory is going out to somebody, and then Yamensa is the one receiving the goods. So the rule is that at any time there's an outgoing item with respect to what? Assets, stocks. What do? We'll have to what? Credit that particular what? Item. But here it was going out as a result of sales. So the sales account will stand for the item that we are trading. So that since it's going out, we are going to what? Credit sales account. And who is the one receiving it? Yamensa. That's going to what? Debited in Yamensa what? Account. And this is on credit. There was no cash received as at the time there was what? Sales being what? Transferred to Yamensa. It It was just a transfer of the ownership, but there wasn't any form of what cash payment. So later he will come back and she will come back and then pay for it. So the account that's going to be affected here is going to what? The sales account. Likewise, since we are having sales here, we are going to open just this sales account once, assuming that this transaction has a relation with what? Example 3 transaction. That means you open just sales account once and then you record all that transaction that will affect sales in that particular account. So let's take note of that because we'll solve a question that have a reflection of what I'm saying. So we'll have sales account coming up here, okay, and then we'll have what? That of what? Yamensa also coming up. Yamensa account also coming up. So let's take note. So what is happening here is that since there is a sale of goods to Yamensa, Yamensa is going to receive it. And we said that we debit the receiver. By debiting to, we are going to record it on the left-hand side of the T account. And by crediting the giver to record it on the right-hand side of the T account. So in the sales account, what do? We record it Yamensa at the credit side. And record what? 1,000. And when it comes to Yamensa, since she's the one receiving it, we are going to what? Debit it in the name of what? Sales. So we have what? 1,000 coming up generally there. So that's the idea when it comes to recording of such transactions. So let's take note of that. Then let's add one more to it and then we move on. Example 5. Short-term loan paid by check amounted to $2,000. So this transaction is where the business actually went for a loan and now they are repaying back the loan. And you're saying that the amount that they pay with check, and that amount is worth what? 2,000. So after they are going for the loan, you realize that it was a loan. So a loan of what? 2,000 organized that they are repaying back, assuming that the amount they receive is equal to the amount they are paying. That is okay. So what it means is that when they go for that loan, they receive a cash, and in return, they are having what? A debt that is supposed to pay in future, liability, a short-term loan, current liability. But we said all current liabilities will have what? A credit balance. So when they go for loan, they receive cash, and to the bank that they receive that amount, it's a loan that they have contracted from that bank. So in the account of the bank is going to be written, the business, so and so business, XYZ business is having a loan amount that is settle for this particular date worth what? $2,000. So they have it as what? Liability in the books of the account. And now they have paid for it. So what are we going to do? Since we are paying for the loan, the short-term loan is for the bank that we took. So the bank is going to receive that loan. So which account is going to be affected? The account that's going to be affected is going to be what? The loan, the short-term loan that we are paying. And what? We pay with what? Check. So since we pay with check, that means you are going to send a check to the bank to cash it out. Right? For the one supposed to receive as what? A payment. So that means that since the check is going to be, and a through bank, then we are going to have what? Bank account also what? Affected here. So we are going to have what? Our loan account. Our loan account. All right? And then we will have what? Bank account also coming up. And since we pay with what? Check, that is through bank, that means cash or check is going out. So what do? An outgoing what asset, what do? We credit it. And then we debit the one what? Receiving it. So we credit the giver. Here we assume the bank is what? A human being. So he is giving. So we credit the bank account in the name of what? The loan that you are paying. And then we debit the loan in the name of bank. And that is all. So we have our currencies down here. And what do? We are going to debit loan account in the name of what? Bank. So we have bank here. Then the loan amount is what? 2,000. We'll debit it. And then what do? We credit what? The bank account in the name of what? Loan. So we'll have what? Our loan here. Then we'll have 2,000 coming up. So this is the idea about transaction in relation to debt and then what? Asset. So let's take note of that.